Let's find the intrinsic value of Whitecap Resources. This is an oil company in Canada. And if you look at a ticker, WCP.TO, the TO stands for Toronto because it trades on the Toronto Stock Exchange. And to figure out the intrinsic value of a company, we have to calculate the future free cash flow, discount that number back to today's dollars. So let's see their market cap, 873.4 million. And then the stock price is 214. So they have 408 million shares outstanding. So when we calculate the present value or the future cash flows, we have to divide it by that 408 million to come up with the intrinsic value of the stock price. And to do a free cash flow discount model, we need actual data. And that's really the best way to value a company, is how they actually perform. You could value a company on the future, but no one knows the future, and you may be wrong. But a lot of people do bet on companies succeeding in the future, because some companies have no earnings and lose lots of money, so they're worth nothing, but people still invest in them. So obviously they invest for a reason. Tesla is an example of a company that's not making any money, but a lot of people still see value in a company for the future. So free cash flow is the lumpiest number when comparing net income and revenue, because it's actual cash that goes in and out. So if they made a really large purchase one year, you're going to see possibly a negative in free cash flow because they spent more money than they generated. But over time, they may not need that large investment again, or maybe for another 20, 30 years, that type of investment. So they don't have to worry about that huge cash outlay. So it tends to be lumpier than something like revenue, which is a lot smoother. As you can see, it's going up. It did have a little downtick. That's just probably because sales went down in 2019. Maybe the oil prices affected that. Now we know what the future free cash flow is. It's already calculated, but we need to know the discount rate. Every company has their own unique discount rate, and we do it by figuring out the WACC. So let's see how much interest they pay in the debt, $52 million. Now let's see how much debt they have. And it's good to understand financial statements, especially if you're investing in companies, because that's really the heart of a company. Because just reading and listening to the CEO talk about a company doesn't give you much information. They're going to say the best things about it, but the numbers don't lie. But you need to understand numbers, though, because numbers can be manipulated, so you have to understand accounting too. So you can see they pay $52 million on their debt, and the debt is $1.4 billion. So it's a 3.75% interest rate, which seems about right. And we have to discount that interest rate by the effective tax rate. So let's see how much income before taxes. So they had a negative. That could skew the number. Let's look at the year before when it was positive. Because effective tax rate should be pretty similar year to year. And this is a model, so you're never going to get exact. You just want to get as close as you can and then make a decision. So the effective tax rate is 30%. That seems about right. Now we have to discount the interest by the tax rate. So they actually pay 2.61% of the debt. It's kind of like your mortgage. You get a tax write-off on the interest on your mortgage. So you actually pay a lower interest rate than what you're stated. Now we need to calculate the cost of equity. So we need the beta to see wow, I never saw a beta above 3. It's really volatile stock. 3.2, it moves more than 3 times the market. So their WACC, which is a blend of equity and debt, is 11.97%. And it's not just an average of these two numbers in orange. We applied against a weight of equity and a weight of debt. See, they have more debt, 61%, than equity in that capital structure. $1.4 billion of debt, and their market cap is up here. It's less than that. It's 873 million. But let's look at the model. So we predicted the future free cash flow based on the past, and we got a terminal value at the end. We discounted those numbers, and the present value of the future cash flows is $959 million. And if you divide that by the number of shares outstanding, you get an intrinsic value of $2.35. So this is really close to the actual stock price. So this is a good sign, because when you see like crazy numbers on these models, that just means a company is in a growth stage and you really can't value them using this type of model. But in this case, it worked out. And let's look at the stock price the past 5 years. So the stock price, it was much higher than $2.35. It was well over $12, $13 at one point. But it's hovered around $10, $9, $8. So it's been trading at a premium for many years. But now once Corona hit and oil prices got slashed, it's come back to earth, the stock price, and it's trading at around intrinsic value. So it's considered a buy according to the model, but now your job as an analyst will be to look at the future. How do you look at the future? That's a hard thing. You have to kind of look at a lot of other factors and figure, is this company going to be viable in 3, 5, 10 years? Will the sales stay the same? How will expenses be? That's a lot of calculation, a lot to figure out. But let me know in the comments what you think, if you have any ideas or suggestions on how you would analyze this company. Thanks for watching.